Welcome everybody to our webinar today about the Main Street Lending Program, what we like to call Funding Forward. We're going to ask that you please post your questions in the Q&A only, and we'll get through all your questions after the slides. A recording of this webinar and slides will be posted shortly on our community site at realtimeinc.com, and later today we will also email a copy to participants. Briefly about myself, I am the founder and CEO of MultiFunding. I'm an Inc. columnist writing regularly on business lending issues. I've advised prior administrations as well as the Federal Reserve about the business credit markets. I have a book out called The Growth Dilemma, and for my EO friends out there, I'm a proud board member of EO Philadelphia. My lawyers asked me to share some disclaimers. We are in unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. And we encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. Have you taken the time to think about what is next for your business? This is the time for us to be preparing for battle, and rebuilding, reestablishing, reimagining, and reemerging our businesses is like a battle. It will involve a strategy. Will we pivot 5%, 50%, or 90%? What will our team look like going forward? And how much ammunition will we have to go into this battle? And in this context, ammunition is cash, and we need to think both offensively and defensively. Have you taken the time to think through how much cash will be required to get your business back on a stable footing? What is the best case and the worst case situation, and where will the cash come from? And have you considered what your future will look like and what opportunities will present themselves and how you might fund them? These are all the considerations that I'd like you to think through as you consider the Main Street Lending Program that has $600 billion allocated towards it and is in effect until September 30th, 2020 as part of the CARES Act. It's comprised of 3 facilities, the new, the priority, and the expanded, and we'll take some time to explain each today. Let's give you some context here. There are many comparisons comparing Main Street to PPP, especially in the press. This is not an entitlement program like PPP. These are loans and you will have to pay them back. If your business has been badly hit by COVID-19, your best chances for a Main Street loan will be through your existing bank. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. You will go to your existing lenders as likely as a first scenario. They will consider adding additional debt to your company's more runway and protect their current liabilities. Or new lenders will be looking for strong credits and new banking relationships. And just to round it up, you will get these from a bank, not a fintech company, and there will only be approximately, we believe, about 300 banks across the country participating in this program. To be eligible, your business must be established prior to March 13th, 2020. And if you have 15,000 employees or 2019 annual revenues of more than $5 billion, you are too big. You need to be created or organized in the United States under the laws of the United States with significant operations and a majority of your employees based in the United States. What is the U.S. eligibility test? Your assets, greater than 50% of your assets need to be in the United States. Annual net income generated in the United States, and annual net operating revenues are generating in the United States. Subsidiaries of foreign companies can apply as long as they attest that the cash will not go up to their parent company. Currently, eligible businesses are partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities or tribal business concerns. The Federal Reserve is currently working on a program for nonprofits, but it is not open yet. Ineligible borrowers include developers and landlords, and certain other industries such as private equity companies cannot apply. Affiliation rules apply in this role, so an affiliated group of companies can participate in only one Main Street facility, and the affiliated group's loan cannot exceed the maximum loan amount for that facility. Now let's dig into the new and the priority facilities. They share some commonalities. They are a secure, unsecured term loan. They have a 5-year maturity. The principal payment is deferred for 2 years, and interest to payments are deferred for 1 year. You pay 15% at the end of year 3, 15% at the end of year 4, and there's a balloon payment of 70% at the end of year 5. The loans are priced at an adjustable rate of LIBOR plus 3%. So currently you can estimate that the rate will be approximately 3.25%. Prepayment is permitted without penalty, and there will be fees at the beginning between 1 and 2%, and most likely they will all be at the 2% level, as the bank has to send 1% to the Federal Reserve. The new facilities are between $250,000 and $35 billion. How does it work? They're calculated at 4 times your 2019 EBITDA minus your existing debt. So to take an example, in row 3, a company with $500,000 on 2019 EBITDA, the maximum new loan facility they could get would be $2 million. But if that company already had $1.5 million worth of debt, their potential new money would be $500,000. That same company in row 1, if they had $500,000 worth of existing debt, they could get a potential new money new loan facility of $1.5 million. What's important here is that if you have existing lenders, they have to agree that if your company goes bankrupt, they will share their rights with the new Main Street lender. However, the new Main Street lender does not have to senior or on par rights with your current lenders in the normal course of business. These loans can be secured or unsecured depending upon what other loans you have and what you work out with your lender. And you are allowed to take on additional debt after you take on the loan, as long as it does not interfere with the rights of your lender. Priority facilities are bigger. They range from $250,000 to $50 million. And they are calculated at a basis of 6x instead of 4x. So take the same company with $500,000 in row 3, the biggest priority facility they could get would be $3 million. And if that company had $1.5 million of existing debt, their potential priority loan would be $1.5 million. If that same company in row 1 had $500,000 worth of debt, their potential priority facility would be $2.5 million. What's unique about these is that you can refinance other debt into them as long as it is not with your lender. The lender's rights have to be senior or on par with other lenders that you have. And these loans can be secured or unsecured, depending on what you work out with your lender. The expanded facilities are much bigger. They start at a minimum of $10 million, and they go to $300 million. How do they get calculated? If you take row number 2, a company with $10 million of 2019 EBITDA, the maximum priority facility they could get would be $60 million or 6 times that. If that company already had $50 million worth of debt, their potential expanded money would be $10 million. Here you will apply for an expanded with your existing lender, assuming they are participating, and they will share the rights with your existing lender and also have many similar attributes as the new or the priority, except the fees to get in are lower, between 3/4 and 1.5%. In all these loans, you commit to not pay other debts down that you already have earlier before you pay the Main Street. You commit not to cancel any lines of credits, and you attest that you have no reason to believe that your company will go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including a credit card, in your normal course of business. You can take on additional debt obligations while you have the loan as long as they do not conflict with the rights of the Main Street lender, and you can refinance maturing debt while you have the loan. You do commit to certain compensation, stock repurchase, and capital distribution restrictions. There are some exceptions to these for S corporations or other tax pass-through liability companies. You agree while you have the loan and for up to 12 months after the loan is paid in full, not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree not to exceed that compensation while you have the loan and for 1 year after. For those who earn more than $3 million, say you earn $6 million, what you do is you take the delta between 3 and 6, you divide that in 2, get 1.5, you add that to 3, and that person's cap limit would be $4.5 million. You agree to make reasonable efforts to retain your employees while you have the loan, but unlike PPP, the primary agenda here is saving companies, not retaining employees. If you're working with an existing lender that you already have a relationship with, they will calculate your EBITDA in the same way that they have previously calculated it. If it is a new lender, then they will have to calculate your EBITDA or any adjustments you propose to your EBITDA in the same way that they have historically done it for similar companies like yours. Your debt will be calculated at the day of your application and will include any outstanding and undrawn available debt, both from bank and private lenders. Debt will include, if you have an asset-based line secured by accounts receivable and inventory, it will be the amount that you have drawn, not the amount that you could draw. How do you pick between the new, the priority, and the expanded? Well, let's take in row number 2, a company with $4 million worth of EBITDA and $10 million worth of existing debt. They could potentially get a new facility of 6, a priority of 14, or an expanded of 14. And they would have to calculate it based on how much money they needed, what was going on with their company, and their different lenders. Financing strategy, my friends, is like playing offense and defense. And I thought I would share with you briefly 3 case studies about how borrowers are planning on using this program. One is a company with $3 million line of credit, $1 million drawn. The line of credit has a personal guarantee, and they are planning on getting an MSLP for liquidity. They would rather not draw down the entire line and give themselves some extra cushion just in case. Another is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And finally is a company that is being approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much cash will be required to get your business back up on a stable footing? What is the best case and worst case situation, and where will the cash come from? And as you ponder your future, what does it look like, and what opportunities do you want to consider? Those are the end of my prepared slides. And now I'm going to ask Hannah to take all your questions. We will ask you to please put your questions in the Q&A instead of the chat box. It's just easier for us to get them through.
Thank you, Ami. How do I find MSLP lender? Our bank doesn't currently provide this.
So Ingrid, you're welcome to try to go. The Federal Reserve on their site has a list of some of the banks that are participating, that have opted in. We do have a list that we are working with for our clients as well.
Can I use this money to pay off a SBA 7A loan?
No, you absolutely cannot use this money to pay off. You cannot use it. You can do that if it makes sense for your cash flow perspective, and if you are able to refinance it into a priority facility.
Can I pay off EIDL and PPP balances?
It would make sense to pay off the EIDL balance potentially, although the terms aren't as favorable as the EIDL. It would make little sense to pay off the PPP balance unless you know that it is forgiven.
Can we use the funds for real estate acquisition?
There are no reasons that you cannot use it to acquire real estate, but you would be a little tough to pay off real estate on a 5-year amortization So you have to be very careful about that.
On the issue of PGs, what are you seeing and if being released from that and why?
99% of the banks are pushing very hard for PGs. We are in a rare case or two getting some exceptions for our clients, but the banks are pushing for them very hard.
When do you expect the nonprofit program to be launched?
We would hope in the next few weeks, but your guess is as good as ours.
Are typically real estate investment entities eligible, an LLC holding an office park valued at 75 million?
No, real estate developers and landlords are not eligible for the program.
We are a high-tech company and don't have EBITDA profits. Must be profitable to be eligible, correct?
Yeah, correct. You have to be profitable to be eligible for this program.
Are you to be forgiven PPP funds considered debt?
Yeah, they will be considered debt until they're completely forgiven.
We only had 18K of EBITDA in 2019. 6 times this only gets us 108, not meeting the 250K minimum. Are there any options for us with this program?
They are not with the Main Street. There might be some programs for you with the SBA, but not with the Main Street.
Can I use it to pay off an equipment loan with my bank?
Sure, you can use it to pay off any debt as long as the cash flow and the amortization makes sense. And you're going to a new lender. You cannot do that with your existing bank, but you could do it with a new lender.
Can we use the funds to buy out existing partners?
Yes.
Can you quickly go over the types of facilities again and their corresponding EBITDA ranges?
So there's the new, there's the priority, and there's the expanded. The new, really, the EBITDA is difficult because it really is driven by how much debt you have. But the new is 4 times your 2019 EBITDA minus your existing debt. Your priority is 6 times your EBITDA minus the existing debt. And the expanded is a factor of 6 times your EBITDA, also minus your existing debt. But the minimum there is $10 million.
What is the interest rate?
Interest rate is LIBOR plus 3, so you can count on approximately 3.25%.
Does a priority loan prevent existing partners from receiving their current guaranteed payments and tax distributions?
It doesn't prevent them as long as, but they cannot exceed what they were in 2019.
Are general contractors eligible?
Yes.
What are the minimum loan levels for small business for self-storage?
It's an interesting question. I'm not 100% certain a self-storage facility, we would need to get guidance if that was even eligible, because they might consider you to be a landlord effectively.
Would the lender consider an existing SBA loan as debt since we'd be using the MSLP to pay it off?
It would be calculated in how much. Say you're eligible for $6 million. It is, if you're eligible for, let's say you have $1 million of EBITDA and you're trying to get a priority facility, and so the maximum loan you could get is $6 million, but you have $1 million worth of debt that you want to refinance, you could still get the $6 million, but they would refinance the one and they would give you $5 million of new money.
Should we wait to apply for MSLP until the PPP loan is forgiven?
I wouldn't recommend that because the PPP forgiveness process could take up to 5 months, and the MSLP program, as of right now, it ends on September 30th.
We had 2.5 mil in revenue in 2019, but no profit. Are we eligible?
No.
Our bank participates in the program. Do they determine in which category do we fall, the new, priority, or expanded?
They do. You'd have to work that out with them and really understand what your needs are and what you're trying to accomplish.
Would a company that has a property management company as a separate company from the owned properties qualify?
Potentially correct, but only based on the EBITDA of the property management company.
We have typically paid out to shareholders in profitable years. It sounds like we would not be able to do so if we had the Main Street loan. Is that correct?
Yeah, Ari, there's some nuances there that we are working through. We'd have to discuss that offline.
How will banks approach the evaluation of professional service firms?
I'm not sure I answered the question. Any company is really driven by their profitability, their EBITDA, and their ability to pay back the loan. I don't believe the industry they're in particularly matters.
What is the average amount of time from finding a lender to getting funded if qualified?
This is a new program that literally has been live for about a week. So that's a little bit unclear, but we are telling our clients to estimate 6 to 8 weeks.
We will have used $800K of PPP funds on payroll only by the end of August, and forgiveness will be given, but not until the end of 24-week period. Is there any way to exclude this from the calculation?
No.
Why are banks seeking personal guarantees for business loans when the company is profitable?
It's very typical for banks to try their hardest to get personal guarantees whenever they can. So again, there are some unique situations where we seem to be having some luck with some lenders working a way out of the personal guarantees, but they are few and far between.
Can the loan be forgivable like the PPP?
No, this is absolutely a non-forgivable loan.
Can the priority loan proceeds be transferred to a parent company?
Unlikely.
We have an LLC, and can salary to the 95% owner be added back into the EBITDA?
Most likely, but that would be a discussion with the bank.
Can the MSLP be used to acquire a new business?
There's no reason why it cannot.
We have about 100K EBITDA and owner comps about 150K, some W-2s and others. What can be add backs?
That would be really dependent upon the lender you were working with and how they would calculate the add backs. We could discuss that offline.
How would this impact if we get acquired in 3 years? Can it be transferred to the new owner, or will it need to be paid off?
Yeah, we're working on that right now, trying to get an answer on that. We're not sure. At this point, we're assuming it would have to be paid off.
Interest payments are deferred, which mean you still pay the interest. Not sure about what they mean prepayment permitted without penalty. Does this mean if you don't pay interest, if you don't pay the loan before 1 year?
No, the interest clock starts ticking on year one. So while you have no payments in year one, so you paid it off at the end of year one, you would still be liable for the interest that was accrued.
So if our EBITDA is close to 900K with no debt, our loan can be up to 5.6?
Correct. Correct. 5.4.
Does current PPP funds prior to full forgiveness need to be included in the calculation?
Yes.
This loan does not relate in any way to payroll, correct?
Correct.
We had profit in 2017. Does that help us make us eligible? Also, we closed out restaurants in which we lost money, but the catering end is profitable.
It's really driven by profit in 2019.
Is the debt both short-term and long-term, or just short-term? We have convertible equity notes long-term on the balance sheet. Can they be removed from the debt?
Any debt that is included, it doesn't matter if it's long-term or short-term. And it is our belief right now that convertible debt will be included if it has the potential to be considered debt.
If my bottom line shows marginal profit, but I have 200K in depreciation, may I add that back into the calculated EBITDA?
Yes.
What if for a startup in 2020 but profitable?
That shouldn't matter as long as the company had enough profit to justify the numbers.
So the bank decides how to calculate your EBITDA based on your financial statements?
Correct. Your financial statements and preferably your tax returns.
If I have a holding company that 100% owns two companies, can the loan be applied for and used by the holding company to use funds for both companies?
I think that is a one-off situation that would have to be discussed in closer detail.
The previous question, the startup that's profitable, Edward says the startup didn't exist in 2019.
It had to exist prior to March 13, 2020 to be eligible.
How is eligibility determined between new loan and priority loan?
It's really a matter of what rights you're able to work out with your lenders and how much debt you need to determine which one is best for you. They have exactly the same financial setup.
Susan's asking if the session will be recorded. She couldn't join. Yes, we will be sending out the slides and a recording later this afternoon. Is MultiFunding our participating lender?
We're not a lender, we're a broker. We're working with about 40 lenders across the country on the program for our clients.
And asking about a list of lenders and if we have what are our fees to help facilitate this loan.
No, we don't, there's a list of lenders on the Federal Reserve Bank. It's not complete. We have our list of lenders and we're happy to discuss our fee arrangements offline. What
is the small size that MultiFunding will work with?
We think it's the smallest ones we're working on are $1 million. And we think it's be very difficult to get, even though the program is open for it, we think it'll be very difficult to get a Main Street loan anything short of $1 million.
Does 2019 tax returns need to be filed to be eligible?
They do not, but it certainly is helpful. And if they're not filed, the lenders are going to look for some kind of reviewed, audited, or compiled financials that your accountants put their eyes on.
Does an asset note owed to us offset debt notes?
No.
It looks like we have a question in the chat. What if you generated a positive net income in 2019 but have accumulated losses prior to 2019?
That should be okay.
Okay, we're all caught up on questions at the moment.
Happy to take any other questions from the audience.
What's the max MSLP loan you think you will get administered? Be administered.
You think will be, the max loan is as high as $300 million. All right, folks, we certainly thank you for your time. Is a shareholder loan considered debt in this calculation? Absolutely. How long do we expect the funding to last? As of now, the program is open through September 30th. We think they will likely extend that, but we don't know for sure. What happens for affiliated companies, and should we apply under two companies? Affiliated companies you can apply under two, but it has to be for the same facility and they cannot exceed the total amount of the facility.
There's a question in the chat. When are eligible borrowers going to be allowed to begin applying?
Eligible borrowers are applying. A few loans have already been approved by and sold to the Federal Reserve, and the program is moving.
As a single member LLC, 100% owned by myself, a personal loan to the LLC, does that still count as debt in the calculation?
It will count as debt to the calculation, yes.
We were profitable in 2017 and 2018, more than 2019. Is only 2019 taken under consideration?
Correct.
Would we still qualify for a loan if COVID is significantly stressing our current business?
You would qualify if you were profitable in 2019. However, if you're being significantly stressed, you will most likely, if you have a shot of it, get it from your existing lender that you already have a relationship.
Can you get an MSLP even having received the PPP loan?
Yes.
Are there any options to extend the term beyond 5 years?
Not at the moment, but certainly you would, if things go well, you would have the option to refinance that balloon payment later on along the way.
Do EIDL conflict with this MSLP?
Most likely you'll have to refinance your EIDL into the MSLP in order to sort out the lien issues.
If paid off before the first payment is due, are there a penalty?
There's not a penalty, but you will be responsible for the interest that has accrued. All right, folks. If there's one more.
Should we expect an excess cash flow sweep payment on the MSLP?
No. We will be emailing everyone a copy of the recording and a link to the recording later today, as well as posting it on our community site at realtime.inc.com. And if anyone wants to reach out and discuss their personal situation, we are happy to go ahead and email us at ami@multifunding.com. We certainly thank you for your time and wish you all Godspeed.
Thank you, Ami.
Thank you, guys. Thank you so much.